I want to welcome everybody to the Tier 2 Countdown to Retirement seminar. We're going to go over several things during the seminar, um, most of which you can always contact us and ask questions. And to do that, this next slide that we're going to here gives us our contact information. The number one way I recommend members contact us is actually email us. You just send an email to General Sir's email. When it comes to appointments and numbers for your pension, that's really done about a year out. So if you're within a year of retirement, make an appointment. But for general questions, you can call our call center, or again, I recommend the General Sir's email that's on here. We can answer a lot of things through email. When it comes to Tier 2 and the terminology, we always start with annuity. Annuity is your monthly pension payment paid for the member's lifetime. The other thing that goes along with Tier 2 is CPI, or Consumer Price Index, um, which is annual pension increases of is half the CPI or 3% of the pension, whichever is less. So your pension raises will be half of that CPI or the 3%, whichever is less. And again, Tier 2s are individuals who became a member of CSRS or a reciprocal system after January 1st of 2011. That also means you'll hear a lot of Tier 2s email us and want to buy their qualifying period. You don't have one. You automatically, as soon as the day you started working for the state, became a member of CSRS. Now, once vested service credit has been met, members will be qualified for monthly annuity after reaching their eligibility date to retire. So 10 years is what it takes to be vested. But that doesn't mean once you get the 10 years you can retire. You'll have to see when your eligible date is. And we'll look at some of that information in a little bit. The best thing I can tell you to do is this website we're going to go over. We're going to go through our general website, and then that's going to show you where to sign up for your member services account. That is the number one thing I recommend everybody do. Sign up for your member services account. So from our general website, you'll see a picture of our building. And what we recommend is you click on the word State Employees Retirement Systems above the left-hand side of the building there. It's right below the CSRS logo. So you'll click on State Employees Retirement Systems below our logo, and then that takes you to this page. Now on this page, there's lots of information. There's insurance information, disability information, your retirement information's on here. This is a page you should always go out and explore, and this is prior to your logging in or signing up for your online account. This is anybody and everybody can look at this. Um, so look at the information on here. We get the little arrows directed towards the retirement. So when you do the retirement, it gives you all your different retirement formulas and tiers. Click on the one that's appropriate to you, and then it opens up more information about those specific retirements. The other thing on our general website is our calculators tab. What's nice about our calculators tab is it's got underneath it a link to Social Security. It's got a service credit calculator for your sick and vacation time. It's got the chart itself for that sick and vacation time. And we'll then talk about that later on during this slide or this seminar too, how that sick and vacation time works for your pension. Now our next slide is going to be where we start to sign up for member services. You'll see member services login. If you click on that, it's going to have other different things pop up under there with more information, but a lot of members use the bottom here. The bottom arrow on this screen is sign in using IL login, and when you do that, if you've never registered for this account, you'll click on the sign up button. If you have registered for this account, you'll just enter your personal email there. That is your username. If you've never registered for this account, you'll need to request a verification letter. That letter will have a code on it that you're going to need to complete the process of setting up this account. You can't register for this account without that letter. So again, that General CSRS email is the best way to contact us to request that letter. Just your name and your last four or your member ID will work to request that letter, and we can send one to you. So if you're signing up, it's going to look like this. And you're putting your personal email in there. We will no longer allow a work email. It's all got to be set up to your personal email. You're entering your name, you're setting up your own password. Everything's brand new. So you're doing this all from scratch when you're signing up for this account. And when you get into it, it looks like this. It always pops up on this at first. CSRS membership record on the left, basic tab on the right. Just look at your different tabs along the left though. Each one of those tabs as you click on opens up more information to the right. CERS membership record is the only one that's got more different other smaller tabs on the right that you can click on. So like our basic tabs just says um, our general information, but our birth date, how old we are, the membership date when we started, our tier to status. And what's nice to know too is this little pay code down here below, this little 10-000. Now everybody's pay code is going to be a different number, but that pay code, if you click on it, it actually has information on your agency's payroll and your retirement coordinator and everything at your work. Because as an organization, not only with CERS when you retire later on, you're going to organize this to go along with at work for your resignation and things like that, which we'll go over again later here in this seminar. The next screen is going to be the next tab over, which is our account tab. We're going to go over these next three things, which is all underlined here, which is our total contributions, our FAC summary, and our earnings calendar by calendar year. So the first underlined thing is our total contributions. When you click on that, it's going to show you what you paid into CERS. Now, what you pay into CERS is based on your retirement. If you're alternative, you pay 8.5%. If you're regular formula, you pay 4%. Now, there's two parts to our retirement when we pay in. 0.5% goes in what we call widow and survivor. So on this screen, this widow and survivor money is 0.5% of your overall contributions you paid in. At the time of retirement, if you are single, have no dependent children under 18, or no dependent children under 22 that are full-time college students, you are eligible to take this money as a refund because there's no one who's going to pay a survivor benefit if you pass away. So again, if you're single at the time of retirement, have no dependent children, you're eligible to take this money as a refund. There's a question actually on the pension packet that you'll mark yes to take this refund. Now that being said, we have had a lot of members take this refund at retirement and then they get married later on in life and they forget to pay it back. If you don't pay this back, if you take the refund and then get married later after retirement, and you don't pay this back, your spouse then does not have a benefit. That new spouse would not have a survivor benefit. The rules for the survivor benefit is if you're married for at least 12 months before you as the member pass, they would get a survivor benefit. But if you've taken this refund and you've not paid it back, that doesn't apply. So that's why members, if they get married after retirement, should contact CERS to see what it costs to pay back that survivor refund. Our next screen is underlined is going to be our FAC. That's our best 96 consecutive months of earnings out of the last 10 years, our 120 months worked. So what this does is the system averages all your earnings for those 96 months, month by month. It throws all the money. So every time you're working into the future, like say today you worked this month, that knock in this month's earnings is higher than the month 8 years ago or 96 months ago, it knocks off that lower month. So it keeps going forward. It keeps building up. So that's a really important part of the calculation for your pension. We'll show you that here in a little bit too. The next screen is our earnings and service credit by calendar year. This is really nice. This goes back to your start of your state career. It tells you what you made month to month. If we look to the right, the far right, as long as we have a 1 there, in each of the years at the end, the totals, that means we worked a full year of service. So for this example in 2018, they only have 0.9167, but that's because December's not posted yet. This was just, again, this example. So this is month to month to take these earnings post. It does take a little while from the time you actually get paid these earnings for it to post in your account. So if we think about it, we're 2 weeks behind in pay, so that 2 weeks behind, then we get that pay date, then we get our paycheck that's 2 weeks behind, and it can take a week or two after that for our system to process that payroll file to go into your account. So there's a little lag in this getting updated along with your FAC. But that's just normal. There's nothing we can do about it due to the way things are processed. Now, these yellow highlighted lines is important if you ever bought, you guys as a tier 2, again, you wouldn't have a qualifying period. Now, you may have a short period, you might have military time. If you ever made a service purchase on your online account under this service and earnings credit by calendar year, these yellow highlighted lines, the month you completed that purchase is the month that the service goes into. It doesn't go back where you worked it. It goes into that month you completed the purchase. That's why we have a lot of members that may have worked prior to being a tier 2 rules, tier 1s had to serve a 6-month qualifying period. So a lot of members worked during the summer at an agency, and they may only work 2 or 3 months. Well, you didn't contribute then because the rules were different back then. If that was something you wanted to purchase, it's called a short period, that goes into the month you finish the purchase. It doesn't go back to the time you worked it. So therefore, you're still a tier two. So we see that once in a while. Somebody worked for the Department of Ag or at the fair, and they go to buy it. No, it's still you're still a tier two because that money is coming in the month you complete the purchase. You can't backdate it. It's got to go in the month you complete the purchase. So this chart's very handy. Look it over, see if something's missing. Maybe you went out on a medical leave of absence, you got a little time missing. Just different things like that. Our next screen is going to be our benefit tab. This is the most important tab for most of us. It tells us what date we're eligible to retire. It tells us our pension amount. And again, anything underlined you click on. So if we click on your pension benefit calculation, oh, sorry, we're doing the on-demand statement first. So on-demand print, on-demand statement. And we're going to look at that on-demand statement because we no longer generate annual or yearly statements in June anymore. You can print them on demand, and that's because we came up with this online account which keeps track of everything a lot better than that 1 year little flash and 1 year little snapshot in time during that calendar year. This you can look at every month. So on the demand statement, it tells us your membership date, total contributions, monthly rate of pay, service credit, final average. It tells us the same pension. It gives you the same retirement dates and the same pension amounts, like from your benefit screen there. And then the line below that, though, was the pension calculation. So we're looking now at what that calculation looks like. That was the dollar amount next to the date you're eligible. And so when you click on it, it shows you the way it works. So your years of service is your overall percentage for your pension. So again, the longer you work, the higher the percentage you're going to get. And then that FAC we talked about earlier, that's that 96-month average. That's what that FAC is on this screen. So we take our percentage times our 96-month average, that 8-year average. That's how the pension's calculated. So again, the longer you work, the higher the percentage, the more money or higher earnings you can make with the state, the better you can make that FAC average, and that all in turn makes your pension better. And it tells you down below when you click on it what rules you're meeting. Like this person was tier 2 eligible at 67 in 10 years. They just need 10 years of service. That's a general rule. But this tells us, this little $5.94 down here, that tells us each month we're working adds about $5.94. Or when we look at the sick and vacation time later, that gives us an idea of how much that's going to add to your pension benefit by having that sick and vacation time on the books, and that equals service credit, which adds months of service on top of what you've already worked. Our next screen is a example of a mixed formula. So this person was alternative for a while, probably worked at corrections, and then they went to work at a regular formula job. And this person's also, because they're retiring out of the regular formula, not the alternative, is 75% is the max they can have. So, but it shows you how you mix that alternative formula time that you may have worked at corrections for a little while, then you went to an office or state job with the regular formula calculation. And it shows you how those are mixed together, and basically you just add the overall percentage. And then you're taking that percentage again times that FAC, that's the pension amount. So everybody's percentages and calculation for their pension is different because everybody's earnings is different. Depending on where you work, depends on what you're making. If you're getting the 2.5% in alternative, or if you're getting the 1.67 for regular formula. But it tells you down below again what rule you're meeting for this retirement. The next part of our benefit tab, and this will also print on that on-demand statement, is your disability benefits. So that's this top part, non-occupational and occupational. Basically non-oc, if you're hurt on the job or hurt outside of work, non-oc is what you apply for. Occupational means you're getting paid by workers' comp. If workers' comp's paying you, make sure you always apply for disability with CSRS. So we have a lot of members that get hurt at work, they start their workers' comp benefit, and they think that's everything they're supposed to get, and it's not. You need to apply for disability here at CSRS. Same way at work. The non-OC is if you go on a medical leave of absence, there's rules you'll have to follow um, before you could start this benefit, but you got to turn in paperwork to do so. And sometimes the agency doesn't tell you. Now, below the disability information, this is where it gets a little confusing. So I'm going to hopefully I can break it down for you to understand. But um, basically, non-occupational death or your survivor monthly benefit, that's what your spouse would get. Or maybe you don't have a spouse, but you have a dependent child under 18 or a child under 22 that's a full-time college student. So those are the ones that are eligible for a pension. If you have a child over 22, um, they're not eligible for anything, not for pension part anyway. Now, for me in my situation, I have a spouse and I have a child that's 16, so therefore this non-occupational death family maximum monthly benefit is what they would get. And what they would do is they'll pay to my spouse. But then when my son turned 18, if he goes to college, they'll split the money between my wife and my spouse, and then when he turns 22, it all goes back to my spouse. Now, that's for the monthly pension benefit. Everything down below, of course, the occupational death means you died on the job, so that's a higher benefit that they pay to your survivor, like your spouse or your children, depending on their age of the children, of course. Now, down below belongs to the beneficiary form. So when it comes to a monthly pension, that's by law and by definition of who we consider a survivor to collect that. But down below is from the beneficiary form. So if I don't have anybody that can collect my pension, if I passed away, and they look at my beneficiary form, they're looking at the lump sum death benefit without eligible survivor amount that goes to them, whoever I have listed primary on my beneficiary form. Now, if I do have a survivor, such as my spouse, we'll say, and I pass away, they're not only going to get the monthly pension benefit listed above, depending on which one they qualify for, if it was just them getting it or if it was a family or if I died on the job. But they're also, now if I have them listed primary on my beneficiary form, that's the lump sum death benefit with eligible survivor at the bottom. So they're not only going to get the survivors, not only going to get the pension benefit, they would also get this benefit. Now this money really changes greatly once you retire. That basically those at the bottom, those big dollar amounts that go to your beneficiary once you retire after so many years of retirement, those are gone. So you're really only looking at the survivor benefit. If you have a spouse, your beneficiaries then would get, after so many years of retirement, and say you don't have a surviving spouse or something like that, they're only going to get $500 off that beneficiary form. Now, next screens are total buyout. This is only going through June 1st of 26. So if you watch this after June 1st of 26, there's a good chance it won't be there. So you can click on if you're married, and then if you are, you enter if you click yes, you'll need the spouse's birth date, and that will put that in information. But the total buyout, what that is a one-time lump sum benefit, and you're done. You get no monthly pension. So for instance, this person has a total buyout of the $1,165,424.59. But the monthly benefit down here that's talking about the 99.18 is done. You're not getting that. So you're giving up this monthly benefit to get this one-time total buyout amount. Usually it only takes about 8 to 10 years if you kept your normal monthly benefit to equal that total buyout. So we don't see a lot of members taking this at this time unless they have some health issues. And again, maybe they don't have a survivor, meaning they don't have a spouse or dependent child that's eligible to collect a monthly pension, and they have some health issues. Maybe talk to a financial advisor, though. I do recommend, no matter what, before you take something like this, you talk to a financial advisor and see what they say, because again, you're giving up your monthly benefit. Now, you are eligible still to take this total buyout and still to have health insurance, even with taking the total buyout, but the health insurance doesn't go in place till you would have been really eligible to retire. So if you're taking this, you have 10 years of service as a tier 2, and you're taking this 10 years before you would actually be eligible to retire, you wouldn't have health insurance till you were actually for another 10 years, even though you get this lump sum money. But there is health insurance with this. It just depends on when the eligibility date was for your original retirement date, when that would start. Again, talk to a financial advisor before you take something like this. Our next thing is our calculators button. I really enjoy this calculators button. It's really nice. It's added um, made it really easy for the member to use. You just got to know what to enter where, and I'll help you with that here. So you by clicking the box, you know it's just an estimate, but it's fairly accurate because the system's smart enough to kind of look into the future too. If you put a future date in there, which I'll show you in a minute, to use your future, it knows you make a certain dollar amount a month, and that money will replace the money that you made 8 years ago. So it will put that in the system and readjust that FAC basically. Or it will give you the soonest date of retirement. So we start out with this. We click this start estimate. Everybody pretty much on here is only going to have sick time after December 31st of 97. I don't see how anybody could have, if you're a tier 2, your sick time is always going to be after December 31st of 97. So you put the sick days there, ignore the other two things. The other box is vacation days. Put your vacation days in there. And when you put that sick and vacation time in here, the system does its own calculation for service credit for that. So by doing that, you'll see on the next screen, I guess, sorry, if you were going to elect, there's a level income option too. But as a tier 2, since you're retiring usually between 62 and 67 if you're regular formula, Social Security is its own benefit at that time. So most members don't choose that. So again, the bottom of this, after you enter your sick and vacation times, the level income. If you chose elected level income for age 62 in 1 month, again, most of the time you're going to go out and get your own Social Security benefit and not do this level income and keep your pension separate from your Social Security. You could do elect the age at which you receive unreduced Social Security benefits, which is 67 for most everybody. So you have those choices. That is something I'd ask about before. You can enter your numbers in there though. If you click on it, click on one of the boxes, like if you chose my full retirement age or the unreduced Social Security amount, that's age 67, there'll be a place to put your Social Security benefits, which actually doesn't show that screen, but there'll be a place to put your Social Security benefits so it adds into the pension. Most of us are just going to do this screen and do the after December 31st of 97 and put our vacation days. Most of us won't do the level income. And then it gives you your separation and retirement date. And that's the big thing with retirement. You can only retire in the first of a month. Period. No other retirement date. You're retiring the first of a month. And that retirement date's only after you've separated or resigned your job at the end of the month. So you're always resigning at the end of this month, but retiring with CSRS in the first of the month, and that just usually, if your account and everything's good, it just keeps your health insurance and everything just stays in place. You don't have to worry about it. But there could be some differences and changes in that depending on your age. But this will show you when you put that sick and vacation time in there, and maybe you're older and you started with the state and you're just trying to get to that 10 years, and this would just show you your soonest eligibility date. It automatically would move stuff back the way it's supposed to be. Or you can put a future date past the date it shows on this. You can change these dates, but you just always use the end of the month for the separation and the first of the month for the retirement. And then you would hit next in the middle of the screen there. And then it shows you your pension calculation. So this person's pension was $728. And they had to use their sick and vacation time to get out. So this person was just trying to get to their 10 years. Your screens will all be individual. Again, play with that calculator. You can play with the dates. It's great. It makes things a lot nicer. And the one thing is you can always print this. So like if you did this down and printed one off and then do it 2, 3, 4, 5 years, whatever down the road and print another one off, you'll see a big difference even though you're looking at the same date and the pension amounts. And that could be due to raises and things like that in the future that you could get that changes that calculation with those earnings. Our next one is our nominated beneficiaries. Make sure you have some on file. Those beneficiaries forms are on your online account, which I'll show you here in a minute. They're under the Forms and Applications tab, actually the bigger gray tab on the left, down a couple from this nominated beneficiaries. Now, your beneficiary form with us doesn't update deferred comp if you have deferred comp, and it doesn't update MetLife or the state life insurance one. Those are all separate beneficiary forms. So the beneficiary form looks like this. Again, you can find this on your online account under the Forms and Applications tab. Make sure you have one filled out. What's great about it is if you pull it up on your online account, you can type it as a PDF before you print it, so that way you don't miss the line. Because there is a big bold box, and inside that box you can kind of lightly see it's a little hash line, and so therefore you write beneficiary name, the last name, first name, middle initial above the hash, and then below you would put the relationship and phone number, and so forth the next few boxes. You just follow the example there at the top, and you have to sign and date these. We will not take a digital signature, so you will have to sign and date these, and then you can always scan and email them too. We do take processing forms through the General Service email, which is great, and then we will reply back confirming we got this through that email. Now, always with your beneficiaries, keep them current. Make sure the names and addresses, if they change, you update the form. Identify your spouse, son, daughters. If you have a minor listed as your primary, the guardians will be the one if something happens to you that takes care of the money for that minor until they become adult. If no beneficiary is listed, your estate is your beneficiary. And again, changing your CSRS beneficiary form does not change the one for life insurance to the state. That's through my benefits. And it doesn't change the deferred comp one. That's again through deferred compensation. Our next line here is our demographics. If something's wrong with your address, you cannot update that with CSRS. The only place to update your address while you're an active working member is with your payroll department. So you'd fill out the C26 form there. And basically, if you ever move or anything, you update your address with your agency or your payroll department. That will then in turn update your account in CSRS. And that's because your account is all driven by your agency payroll. All your earnings and information we get in your account comes just from your agency's payroll file that they send to us when you get paid. So we don't have personnel files. We don't have any of that other information. We just have payroll files. That's it. So we don't know what's going on at the agency with you. We just have what you're making per month and how that drives and builds your retirement account. Address changes before retirement, again, contact the agency payroll, do the C26 form. After retirement, then, that's always updated with us. And after retirement, when you update that address with us, we will also update it with my benefits. And that's very important for health insurance. Our next screen here is our Forms and Applications tab. This is a very important screen. If you ever need to go on disability, whether that be non-OC or occupational, at the bottom of the screen you can see CSRS members packets. There's your packets you fill out. If you're going to retire, you're eligible to retire, there's your pension benefit packet there at the bottom. And then what happens later on, and after you have retired, we'll say, you don't need any of these packets anymore. All these CSRS members forms that over doubles in size for your forms. So you'll have tax forms and direct deposit forms and things like that after retirement that pop up on the same Forms and Applications tab that you'll need if you ever need to update the information with CSRS anyway. But currently that's where your beneficiary form is there at the top. That's a very important form to have on file. I always recommend having that on file with CSRS. If you don't right now, I would recommend signing into this online account and getting that form. If you can't get into this account, we can always send one to you. And again, you can request that through our General CSRS email or the call center. Service purchase tabs. You're going to click on the top line there where the arrow is to request a cost of service purchase for which I may qualify. And basically, as a tier 2, you would have some things to order like short period or military time, things like that. But it's all done through your online account. You can't request that through the email. You actually have to physically get into your online account to order service purchases. We don't do paper. We do it this way electronically. It's much more faster and more efficient for us. It keeps things so that we don't have to redo things over and over later on. It gets you a letter faster later down the road if you decided when you first ordered something. Because just because you order this letter now doesn't mean you have to buy it. It's up to you if you want to buy it. So I always recommend members order the letter, see what it costs, see what this is going to do for your pension, whether it's going to add some money on top of it, it's going to get you out sooner. There's several different things that the service purchase could do for your pension. But order it. If you don't like the cost because it's too expensive, you don't have to buy it. Our next screen, though, if we clicked on that, that's going to show us the things we have ordered. For example, and this is also the screen that you'll also click the blue to order your estimate. We showed an example of a member that has ordered different things. So when you order something, when this blue tab box is here and you click on that to put your estimate in, if you go back to the screen, if it says all this information across like you see here, like status, this would be in review process or status though. But if it says submitted date and everything, that means you did everything correctly. So for instance, we're going to click on again the top line, request the cost of optional service purchase. We're going to go click on the blue tab then, add new estimate request. And then we're going to get to this screen. We're going to click on create request. Go ahead and leave your retirement date there. Now if this is a member that you're looking at retiring sooner than that date, then you can put that sooner retirement date in there. But as for if it's a few years before you can retire, just leave that date in there and then click create request. And then when it gets to this screen, you're going to click on the add optional service button. What this button does is after you click that, it brings a drop down box appears. And then you're going to click the type of service purchase you're requesting. So there's some Gypsy leave of absence. That's like if you went out on disability or something, there could be a little time for medical leave of absence. Legislative staff internship. We'll see a lot of military time purchase. You guys will not, if you're a tier 2, you will not have a qualifying period. That won't exist for you. But you could have a refund possibly that you've taken because you left the state and come back. Or you could have a short period where you worked prior to that 2011 date, but you only worked for 2 or 3 months, and then you didn't come start full time with the state till after 2011. So we see a lot of military mostly when it comes to the tier 2. If you need some assistance with that, we can help you too with the what you click on. Certain things you will need dates. So like short periods of qualifying, well, you don't have a qualifying period, but short period, you don't need a date. But a refund, you'll need the dates to and from that you worked that refund consisted of with the state. Military service, you'll need a to and from date from when you were on active duty in that military time. Our next screen here is going to be where we submit requests. So after we've added the optional service from the screen before from the drop down box, enter the information it requested, we're going to then hit submit request. And once we do that, that will go into here. It'll go into that box to be ordered, and it will take about 4 to 6 weeks to get that letter. Under our next service purchase tab, this is for somebody that's going into retirement. At the end of your career, your service purchase, you can actually purchase time with your vacation, meaning we have a chart we look at. This chart tells us how many days list days on this chart, and there's ranges for these days, and that service credit you can buy with your vacation time. Your sick time is just free service. You don't pay anything for it because you don't get a payout from the agency. With vacation time, its number one thing is agency owes you money. The number one thing also is you're not giving anything, you're not giving up your vacation days that are getting paid to you. When it comes to the service purchase for your vacation time, the agency will take a little money out of your vacation payout to send to CERS to buy the service that equates to. So if you do this, you're going to do this with your agency. Even though this is on your CERS online account to do the election to complete it, you're actually doing all this with your agency. They're now entering this information on their dashboard at work, and then they'll tell you when to come out to your online account to finish this election. So if you say, yes, I do want to buy service credit with my vacation time, and they have you direct you out to your online account, this is what it's going to look like after they tell you to go in here and make your choices. So most members do the pre-tax. You could also on the screen decide, no, I don't want to buy this, but most members do the pre-tax option. Most post-tax option, only members that pay quarterly maybe do that. So when it comes to the pre-tax, what this is referring to is they're going to take the contributions out, which we'll look at this next screen. Like this person's $514 in contributions are going to come out pre-tax before taxes, state and federal taxes come out of it. So in this example, this person is eligible based on the number of vacation days they have to buy a month and a half of service. That's going to cost them $514, but that total lump sum for that vacation time was over $6,000. So they're going to take that $514 out of that $6,000. And then by marking pre-tax, you can then hold that money out before the state and federal taxes, so it lowers your tax liabilities. That's what most members do. But again, some might need to do the post tax if you pay quarterly. But what you're doing here on this screen is when you go to elect this service purchase, you're clicking. If we go back, you're going to click say pre-tax. You're going to hit review and confirm sick and vacation election. Then we're going to go to the next screen. We're going to say yes. We're going to mark these two little boxes on the right here, on the left here, and then we're going to hit submit. And then that goes back to your retirement coordinator, and they'll hit enter. They'll give this information or hit submit on their side after your retirement date. So most of the time, if you're doing this election to buy service credit with your vacation time, again, that's done at the agency. They're going to let you know when this is out there if you said yes, you want to do this, and then they're the ones going to submit this for you after the retirement date. So you just got to know if you want to do it or not and know where to find it to prove it. Our next screen here is our annual statements. We no longer do these. We have that statement on demand button. The last one is actually 23. June 30th of 23 is the last annual statement you'll ever see on your online account, because again, we added that statement on demand button. This is only a snapshot in time. If you want, you can go in and print one of those annual statements every month if you want, or go in once a year, every 6 months or whatever, and print your own now. Or this one, we only supplied it once a year. Our next slides are going to be for retirement benefits. Reasons for the best time to retire. So January 1st is usually still our best time to retire. And the reason is, well, if you're meeting the full rules of eligibility as a Tier 2, if you're retiring, at 67 or older currently, or if you're alternative, it could be age 60. But 12 months later, you get your first raise, which again is at half the consumer price index or that 3%, whichever's less. But January 1st retirement, 12 months later you get your first raise the following January 1st. Now that might not be the case if you're doing a reduced retirement. So if you're retiring under age 67 as a regular formula person, you could be waiting a couple years to get your first 3% raise, because that raise won't, or excuse me, the first half the consumer price index or 3%, whichever is less raise, that wouldn't happen. So if you retired, say at 64, it's the January 1st now. If you retired at 64, it's the January 1st after you turn 67, you get that first raise on your pension. So it just depends on where you're at. Tax purposes, though, retiring at the end of the year, you got a full year working. The next year is going to be retirement for tax and earning purposes. We talked about the COLA. The other things are deferred comp. So like in our example earlier, we had about a $6,000 payout for vacation time. So you do this organization also with your agency. Your agency's the one owing you money for your vacation time, not CERS. But you have the option to roll your vacation payout to your deferred comp. And right now, members are doing that because when you take vacation payouts through payroll, like the agency normally pays it to you, it's about 22% federal and 4.95 state tax. You can avoid those taxes by rolling that over to your deferred comp. As you take it out of there later, it's approximately 20%. But again, that's nothing to do with CERS. I'm letting you know about it so you can have a discussion with your agency, not us, to see if that's something you want to do. Because again, the more money at this point you could roll over to your deferred comp, the more money you're keeping and not paying in taxes. So deferred comp too is available to you 30 days after your resignation. So 30 days after you resign, you can access your Empower account. That's our current investor. That investor could change. It used to be T. Rowe Price. It just depends on what we have. So your deferred comp account's available 30 days after you resign. At the end of the month you're resigning. The first of the month you're retiring, your insurance should just stay in place. Now that doesn't mean that there might not be a change depending on your age when you retire, but the insurance is staying in place. The effective date of retirement is again the first of the month following your resignation, because we're going to only retire on the first. Steps to retire, again, you must resign in writing to your agency. It's highly recommended you turn your packet in at least 30 days from retirement, but you can turn it up to 90 or 3 months prior to the retirement date to CERS. Contact your retirement coordinator directly at your agency. That's who you're organizing the resignation with, the rollover your vacation payout if you decide to do that. And then they're also the ones that's going to ask you if you want to buy service with your vacation time. When it comes to the retirement, we're going to need documents, outside documents besides what's in that pension packet. And that is going to be a copy of your birth certificate as the member, copy of the official marriage certificate from like the county building, and a copy of the spouse's birth certificate if you're married. So copies of the pension application can be downloaded from CERS account, which is under your Forms and Applications tab. The retirement packet includes a checklist. It's very good to go over that checklist. Now, in that packet, right now, currently, there's quite a few pages, but there's only about 6 pages you turn into us, so don't let them overwhelm you. Of the whole packet, you're turning in a retirement application. That's 2 pages. Everything else is a single page. Retirement application, that's 2 pages. Retiree insurance form, direct deposit form, beneficiary form, W4P form. So that's 6 pages. If it's just you as a member, there's a birth certificate required. If you have been divorced, though, we will need a copy of the divorce decree, first page and page with the judge's signature. If you've never been divorced, and again it's you and you're married, then we need a copy of the member's birth certificate, spouse's birth certificate, and a copy of the official marriage certificate from the county building. This is all in that checklist. You follow that checklist, it's just like the second page of the packet. There won't be any issue. It also has a checklist of what you do at the agency. The first part of that checklist is the top part of the page is what you do at the agency. The rest is serves for what you do with the turn in this packet. So our pension is effective the first effective date of the pension is the first day of the month following your date of resignation. Agencies will pay lump sums for vacation, sick, and personal time. Personal time is only half payable, so think about that when it comes to what you have on the books. Vacation times are definitely payable per day. Every day has a value, but personal time is only half payable. So say I had 2 personal days left, they're going to pay me for one, the other one's going to disappear. Some payouts from CERS. So if you have no qualified survivor, meaning you don't have a spouse or a child under 18 or one that's under 22 that's a full-time college student, therefore you have nobody who could collect a pension, that's widows and survivor. It's called survivor contribution refund on the packet though. And then maybe you worked alternative and you didn't meet the full years of needed for alternative, but you're eligible to retire into the regular formula. Then you could get a refund of of those contributions that you paid in excess. So like if you worked 15 years and alternative formula and you paid 8.5% into us, but then you're only eligible, you decide you don't want to work there anymore and you're ready to retire, and you retired right then and there because you were eligible under the regular formula rules, so we'd only need 4%. So you then in turn get 4.5% refund, and that's what they call a refund of excess contributions. Our first payment's approximately 8 to 10 weeks after the date of retirement. The first payment is either mailed to your home or direct deposited into your bank. So it could be mailed even though you set up direct deposit. It varies back and forth. It depends on the comptroller. They're the ones issuing these payments after we put you through the vouchering system. They're the ones that even though you may have had direct deposit on file for years, you're setting up new direct deposit, even though it's probably the same account and everything you had before while you're working. That's all brand new. So they have to run a check on it because you're submitting us a new direct deposit form. The direct deposit form will have to be signed off in the bottom by your bank too for us to accept it, and you'll see that in the instructions on the form itself in that pension packet. Deductions. There's not that many deductions that come out of the pension check. So we got federal taxes as number one. Your pension is federally taxable. Illinois does not tax retirement right now, so we don't have to worry about that. If you do have less than 20 years as the member, you would have a cost for your health insurance. If you got 20 years or more, you don't have that. You won't have that deduction. If you have dependents on your health insurance, that cost comes directly out of your pension check, as long as the pension check's high enough to cover it. Dental insurance comes directly out of the pension check because that could be just for you for the member. Even though you had 20 years for free health insurance, you still pay some for your dental as the member. Life insurance. So if you have the basic life insurance value through the state, that's free. There's no cost for that coming out of the pension check. But if you have extra times your optional life insurance, like times 1, 2, 3, or 4 or more of the salary, then that cost will come out of the pension check for that life insurance value that you have through the state. If you want to do deduction cards for credit unions and other outside insurance policies, you can. But anymore, I see most members set that up directly out of their bank account, so they don't have to contact us to change the dollar amount or whatever they're not going to have to go through us to change it. If you did it directly up to your bank account now, for like credit unions and things like that, then you have control over instantly that day if you want to change something. Tier two members are individuals who became a member of the SERS or reciprocal system after January 1st of 2011. Our contributions are coordinated. So if we're regular formula or alternative formula, coordinated means we not only pay into our pension benefit out of our paychecks at work, we're paying into Social Security. So again, look at your Social Security account. We don't have that information. Um, you can go to ssa.gov and look at that Social Security amount. Contributions non-coordinated mean these are mostly your sworn individuals, your law enforcement. I don't see too many regular 8% retirements pensions anymore, but they do not pay into Social Security. You strictly pay into the SERS system for your pension, but most of us are all the coordinated where we pay into both. Again, how soon can I retire? If you want a non-reduced pension as a tier 2 regular formula, it's age 67 with at least 10 years of service. Um, how soon could I retire if I wanted to reduce pension? So I could retire as soon as 62 if I have at least 10 years or more of service, but it's a half percent reduction for every year or for each month under age 67. So therefore, if I retired at 62, I'm going to get a 30% reduction of my pension calculation. And it'll show you on your online account when it has your different dates on there. And again, anything underlined you click on, it shows you the rules and it shows you the reduction on there. When you click on that reduced pension amount on your online account, it will show you. So the calculation works simple as this. Again, your years of service for regular formula times 1.67 times your FAC. And again, the FAC is the highest consecutive 96 months out of the last 120 months worked. Uh, Non-coordinated employees, this is again those 8% that pay in 8%. I don't see too many of these anymore. Their years of service are at 2.2%. So a little bit of a calculation, but they don't pay in the Social Security. And then alternative formula members are age 60 with at least 20 years service credit. So this is for most of those, basically the members that work in corrections or at the prisons. Um, you're still got the same FAC calculation though. You just have a little bit younger age and less years you'd have to work to be able to retire at 60. But the FAC is still the best 96 highest consecutive 96 months out of the last 120. So again, Department of Corrections, Juvenile Justice, that's our tier 2 formula alternative employees, and you're also coordinated, so you pay into both SERS and Social Security. Um, Alternative and regular time to get a combination of formers requires 20 years of service. So that was kind of our example earlier. So if I worked 15 years in corrections and I left there and I went to a regular formula job and worked 5 years, I would still keep my 15 years in corrections at the 2.5% because I have a total of 20 years. And that again would show up on your online account too. If you don't meet the eligibility for alternative, we talked about that excess refund. Again, we won't keep 8.5% contributions you paid in. We're going to only keep 4, so you get a refund of 4.5. Again, these are only for the alternative formula members that work in corrections. The regular formula, you won't get a refund or anything like that. Our years of service is a better calculation alternative. It's 2.5%. Same FAC calculation though. It's always the best 96 consecutive months out of the last 120 months worked. But you do get a little bit better calculation being an alternative formula. But you also pay in a higher contribution amount. So tier 2 COLA increases, again 3% or half of the consumer price index for the preceding calendar year, whichever is less. Tier 2 increases are non-compounded. Regular formula, the January after you have begun retirement for a full year if you retire under age 67, the January after you turn 67. So, again, if you retired, say, January 1st and you were turning 67 in that year, that next year you might have a little reduction of the pension, but you get that raise that next 12 months later. But if, say, you retired at 62 to 64, 65 even, you're going to wait a little bit because you got to wait till the January 1st after 67 to get that raise. And then it's a little different when it comes to the age 60. whichever's later. Future increases are not limited by the 80% maximum. So alternative formula basically your 32 years gives you 80%. And if you start young enough, because you have to wait till 60 to retire, you're going to add the 80%. So you'll still get raises. It's just they could start a little sooner for you. Oh, COLA was cost of living adjustment. Now, optional service. There's short periods. Does not allow for temporary contractual time though. And there's also refunds. We kind of talked about this all a little earlier. Short periods, again, you might have worked for 3 months for the fair or someplace like that a long time ago. Um, if you've taken a refund though, your service, that means you paid into the system. You left and you didn't think you were going to come back, so you took that refund. That is all optional to buy. Now, to buy a refund, you'd have to work for the state again 24 months prior, or 24 months before you could even order that cost. Short periods, you don't have to wait long like that. Military time, you don't have to have a waiting period for that. You could also order that at any time. Um, it is rather expensive, but the sooner you look at the cost, if you think about doing it, the better. Um, Now, service for leaves of absence, again, it would have to be after 82, which everybody's would be in this seminar, and it has to be less than 1 year. So, like if you were on a medical leave of absence for 13 months, you couldn't buy that. But most of the time, you should have, if it's a personal medical leave of absence, you would apply for disability benefits anyway, so you wouldn't need to buy that. And then it's mostly vacation days is all we're talking about for that service purchase. So again, your vacation time at the end of your career is a payout from your agency, and based on those days in our chart, gives you the number of months you could buy off that chart. And then they'll take a little money out of your vacation payout at your agency to buy that. Um, this is an example for a short period. It normally works out. We'd have to look at this, but it normally works out if you order that letter and get the cost. We can see what it's going to add to your pension. Um, it doesn't usually take you very long to buy to make your money back. It will take a lot longer. For example, like this is a short period, but if it was military time, it would take you much longer because it's usually more expensive. So this is something we'd have to individually look at after you've ordered your letter and got the cost on your online account for the service you're looking at buying. Service purchase options, most members do pre-tax, meaning if you have deferred comp or an outside investment plan like an IRA or like a 401k or something, you can actually roll money directly out of those plans to pay for this service purchase. So it's not coming directly out of your pocket, it's coming out of that retirement investment. So you're paying for retirement with retirement money, is what I say. You can do a payroll deduction. That's also pre-tax, meaning you can set up a payment plan if you decide to buy this service from the letter you ordered. You can set up a payment plan for as little as 12 months all the way up to 60 months or 5 years. Now, when it comes to looking at those service purchase letters, the amount it says you pay, that's per pay period. So we get paid twice a month. So that comes out of each check. But again, that's good for 1 to 5 years for the payment plans on those service purchase letters. You can also use your vacation payout at the end of your career to pay for this, but that's late, and the longer and longer you wait, the more interest you'll pay on the service purchase. So if it's something you want to do and you can afford, I'd tell you to buy these service purchases sooner than later. Post tax means you write out a check to us. We don't take cash, and you can do a post tax installment agreement too, where you send a check in every month to us, or every couple of weeks in that month to us. Most members do the pre-tax though if they can. Sick and vacation time. Our sick and vacation time can help you meet your eligibility date to retire. It can increase your pension once eligibility date has been reached. Counts towards getting your free health insurance premium. And sick time is only worth free service. So you don't pay for anything you don't get paid by the agency for the sick time, but you get the free service. So all the service credit for the sick and vacation time is based on this chart. So we'll notice this has got numbers of days. It's got two different columns of days. And you notice this chart goes from 1 all the way up to 260. And I have seen members with over 260 sick days because they work that long. And if that's the case, because I get asked about this all the time, the chart tops out at 260 is at the top. No. So if you say you had 300, say you had 300 sick days, take 260 away from the 300. We already got 12 months of service credit for that 260. Now go back up to the top and see 40. 40 is another 2 months of service. So if you had 300 sick days, you're going to get 14 months of service credit. For most of us, though, we don't have that. We're just looking at mostly the first line here, 1 to 130. service credit is again is a chart from the across from the range you're looking at. Now I will say you had 56 sick days. We're not getting paid for those when we leave. 56 is worth 3 months of service, but so is 54. Now, when it comes to the vacation, that's a different story. Each one of those vacation days could be $200, $300, $400 a piece. So the more vacation time you have, the better payout you're going to get. So that's a different story. And we discussed the sick and vacation time in the meeting when you're looking at your retirement date. We'll go over that. So we got some examples here. So 67 sick days, or excuse me, 67 vacation days is 3.25 months. Looking at this chart, yep, 3.25. But every one of those days is worth something. So I'll have more than 66. But when it comes to my vacation time for this example, 130 sick days, and I'm not going to get paid for that time by the agency. It's just free service based on the number of days. If I have 130 sick days, I really only need per this chart 119. That's just kind of an example. Now, we don't grant your time off. That's all up with your agency. So if you want to take time off, you got to go through them still. We're just saying that if you had 130 sick days in this example, you'd actually only need 119. Now, when it comes to the purchasing the vacation time service credit, you will be paying contributions out of your vacation payout. And again, we had an example earlier on when we went through our member services account where there's a service purchase link there. So again, when the agency enters your vacation time on their system, they'll direct you out to your online account to finish that, and it shows you an example of what you're paying and things like that. So if you're regular formula, you pay 4%. If you're alternative, you pay 8.5%. But it's the cheapest service you'll ever be able to buy compared to the other letters that you could order. So again, vacation time, if you're not maxed out, I always recommend spending the money out of your vacation payout to make your pension better. Reciprocal systems, there's 13 of these. You make your choice at retirement to use reciprocity. Repay the contributions to the reciprocal system that you took a refund from. So we have a lot of members that didn't realize there was a reciprocal act. They may have worked as a teacher under TRS. They may have worked under state universities' retirement systems. They could have worked under IMRF, Illinois Municipal Retirement System. Those, if you've taken a refund, you got to contact that system to pay it back, not CSRS. Yeah, we don't have anything to do with their refund. But you must be employed with CSRS for at least 24 months to even buy your refund back from a reciprocal system. Or the same vice versa. If you worked for a reciprocal system and you took a refund from us, you want to buy it back, you got to be 24 months somewhere between the two systems before you can do it. You do need at least a minimum 12 months of employment or 12 months of service credit at that reciprocal system to even get a pension. And this can be used with regular formula rules to meet your minimum vesting of 10 years for pension purposes. So you can look at your CSRS time. Say you had 5 years with TRS and 5 years with SCRS, us. So you had 5 years with teachers and 5 years with state employees. You can look at that together for 10 years total. If you're 62 to 67, it could make you eligible to retire. Now, that being said, you have to have health insurance to the state. You have to have at least 10 years vesting in our system alone to be offered health insurance in retirement. So you could be eligible to retire under this Reciprocal Act, but still may not have the health insurance if you didn't have the 10 years with CSRS alone. Reciprocal time may not be used to meet alternative formula eligibility though, and not all reciprocal systems time counts towards health insurance. So say you had TRS time, that time will count with your CSRS time for health insurance cost. Our next screen here is all the listing of the different reciprocal systems, and we do have a reciprocal fact sheet that's on our general website that has a nice kind of little overview of how the pension system, how the pensions work from each system, because you're actually going to get a check from each system. You're not throwing this time from TRS or SURS into CSRS. You're keeping your system's time separate, and you're going to get separate pension checks. Level income, again, level income is not money from CSRS. It's not Social Security. It is, level income amount is money from CSRS, not Social Security. It is basically kind of like a loan from us. If you have a QUILJO, you'll need to get permission from the ex-spouse to be eligible for this. What to remember is this decision is made at the time of retirement application and is an irrevocable decision. So the option is for the members prior to Social Security eligibility. If you're already full Social Security age of 67, you can't do level income. That's your full retirement age. The reduced amount is applicable for the rest of the life. It is your responsibility to apply for Social Security benefits at the time of reduction. So basically, what they're saying is if you choose level income, you get a first pension check. You can never go back. You can't change it. You're done. That's locked in. Second thing we're saying here is the extra money we're going to give you now on top of your pension, that money is actually based on your future Social Security amount, but we're only giving you a percentage of that dollar amount that you're going to get from Social Security. So that's where the money comes from CSRS, not Social Security. But when you turn that Social Security age, we're going to take the full dollar amount away. And I got a little example we'll go over here in a little bit. So therefore, when we take your money away that you're supposed to, that date you said or when you're supposed to start your Social Security, you got to go out to apply for Social Security. We don't do that for you too. That's a separate benefit from CSRS. So what is needed to Social Security to obtain or if you're going to do level income in retirement or to obtain an estimate, we need a PEB statement, or you go through the Social Security website itself and look at your information. You can print those SSA statements, and they need to be signed and dated if you use them. So you sign them and date them so that we know that they're yours. Because when they print out, they don't have any Neddy's names or anything on it. They're just numbers. So this is where from our general website, that's that calculators button we looked at earlier in this seminar. And on that first line, after we click on that, says Social Security Benefit Estimator Calculator. And what that does is it takes you to a link to sign in or create an account. So if you've never logged into a Social Security account before, create your account. Of course, after you set it up, then sign in. And then this is this screen. So as you're scrolling down on your Social Security account, this is this screen you're going to see first. And you see up there at the top, average future annual salary. We want that to say 0. It will have a dollar amount in there. You want that to say 0 because if you're retiring, you're no longer contributing to Social Security, so those earnings are going to change to 0. So that makes a difference in the Social Security benefits. This is then what you would turn into CSRS, what you would sign and date, so we know whose it is. But you can print this. You can print this out. But this is what we need for the level income, or to do the estimate. And again, this is on your Social Security account. Death benefits. Again, death benefits are a lot different now while you're actively working than once you retire. So while you're actively working, if you have a qualified survivor, such as a spouse or a dependent child that's under 18 or under 22, that's a full-time college student, they would get that $1,000 lump sum total. But the monthly annuity is 66 2/3% of the pension. Plus, they also get the health insurance. If you're qualified for the health insurance in retirement because you're over 10 years vested, they also have the health insurance with their survivor benefit. And while you're actively working, then we're going to look at the beneficiary form, and they're going to get what's remaining of your contributions you paid in for your pension. So there's 2 things we looked at while you're active. Now, if you had no qualified survivor, meaning you don't have anybody who would pay a monthly pension benefit, that's where we looked at your benefit screen earlier. That's that higher lump sum dollar amount we're going to pay to your beneficiaries, and it's a higher dollar amount than what we pay to somebody that's got survivors, because it's got 1 month's salary for each full year of service credit up to 6 years, so it's got extra money in it for that. But if you have no qualified survivors such as a spouse or dependent child, we look at your beneficiary form, we look at the primaries that's listed on there, and we give them the contributions that's left in the system. And this is again why you're actively working. Retiree death benefit changes greatly. You'll notice it says "or" down here. So if you have a survivor, meaning most likely you only have a spouse at this time. Most of the time our children will be too old to put, but hopefully by the time something happens to us. But you'll have a survivor, $1,000 lump sum goes to that, say, spouse. Monthly annuity if married at least 1 year at the time of the death of the survivor, benefit contributions are applicable. So you have to be married for 12 months or 1 year prior to your death as the member for that spouse to get it. And again, if you took a survivor refund, which is listed widow survivor when we look at it earlier, but a survivor refund, you got to make sure you pay that back, or there wouldn't be any benefit for this new spouse. But most of us, knock on wood, we're married at the time of retirement. We pass away as the member, that spouse is then going to get that, and then they're also going to get the insurance at the cost you had it. So if you had 20 years of service and you're getting free insurance as that member, that surviving spouse will now have the free insurance with the survivor benefit. Now, let's just say been retired for quite a few years. We have no spouse, no dependent children. Um, we will look at the beneficiary form because there's nobody we pay a monthly pension payment, and that beneficiary form, whoever's listed primary, if you is going to get $500. So if you have two people listed primary, they're going to split the 500. Again, that's the big difference. There's no contributions left in the system after you've been retired for so long because we paid those all back out the door to you first for your pension. Survivor benefits. These are the eligible survivors. Again, a spouse or civil union partner married at least 1 year prior to the member's passing. Again, if you took a refund though of survivor contributions, you would have to pay that back, or this wouldn't be applicable still. Um, Minor children under age 18, children under age 22 that are unmarried and full-time students at college, dependent disabled children over 18. So if you had a disabled child, they could qualify as your dependent for a pension later after the age of 18. And it's rare, but we do see dependent parents who are at least 50% financially dependent upon you. So that would still be considered a survivor. Social Security offset on survivor benefits. So what we're talking about here, this gets really confusing because members think it all has to do with their Social Security. It does, but it doesn't. Social Security offset on survivor benefits means you as the member has passed away, and we look at then what that surviving spouse that's collecting that pension benefit or that survivor benefit off your pension is going to get off your Social Security amount. So all monthly annuity survivor benefits payable on your behalf to the qualifying spouse will be reduced by half of any survivor benefit payable through the Social Security Administration. Your surge survivor benefit will not be reduced by more than 50%. So they're automatically eligible for 66 and 2/3%. But we can still take money away from that because now you as the member's passed and that surviving spouse is eligible to draw off your higher Social Security amount. If your Social Security amount's not higher than theirs, then you don't have to worry about this offset. Um, so this is a good example. So this person passed away, their pension was $2,000. The surviving spouse is getting $1,333. Now that $400 there. So the surviving spouse, because they're at 60 but under 62, so your surviving spouse is 60 to 62 years old, they're getting $800 off your Social Security record. They can't even collect off their own until they're 62. So like I pass away, my wife gains 66 and 2/3% off my pension, and then she's going to also gain my Social Security dollars, and half of those $800 that she collect off my Social Security is $400. So, and again, this is just an example. These Social Security amounts are usually much higher now. So this surviving spouse benefit will be $933. But altogether, they're getting about $1,733 a month because they're getting a total $800 from Social Security, and they're just getting the $933. It's just CSRS is looking at half, taking away half, looking at half the benefit from Social Security they get and taking that away over here from the pension. Now, what happens if at 62 though that spouse now can draw off their own Social Security benefit? So their own benefit on their own would have been about $600. So they're still getting $800 a month from Social Security. Is now $600 comes from their record. So they only gained $200 off my record as the member that passed. So the offset went down to $100. So that changes the pension benefit greatly, the survivor benefit. So they're still they're going to get $1,233 now from CSRS, and still the $800 from Social Security, and it's $2,033 altogether. And again, that's because what this does is this looks at the spouse's Social Security benefit. So the $600, so they're only gaining $200 now off my record. And again, the offset then is half of that, which is $100 now, where it used to be $400. So you will need to choose at the time of retirement, though. You can, as the member, if you have a much larger Social Security amount than your spouse and you think they're going to survive you, you can choose at the time of retirement to have a reduction of 3.825% off your pension right off the top. By doing the Social Security offset, then we do not care then how much that spouse gains off your Social Security record. They're going to get that 66 and 2/3% of your pension, and they're going to get whatever they get off Social Security. But this is a reduction for you as the member by almost 4% of your pension to start. This offset will be applied to your spouse's benefit if applicable. Um, so if you elect to participate and have your pension reduced by 3.825%, we then don't care what your spouse gains off your Social Security record. We won't take anything away. If you do not elect though this, because it's almost 4% off your pension, this will not prevent the pension from being reduced by Social Security offset will be applied if applicable. Basically, we can then take money away from the survivor benefit for your spouse because they can now gain dollars off your Social Security benefit, and we have to look at it then because you didn't do that participation. But again, that's up to you as the member if you think that's worth it. If your guys' Social Security benefits are very close, you wouldn't want to do it. Um, if you never paid into Social Security as a state worker, actually there would be no offset most likely because they're never going to gain dollars off of yours benefit. They're going to have their own Social Security benefit because you didn't really pay in. Now that being said, you might want to look at your Social Security benefits. I recommend everybody when they're going to retire, they have their spouse look at their Social Security benefit and the member look at theirs just to see what they are. Again, if the spouse receives a higher Social Security benefit than you did as the member, then there's not going to be an offset. Survivor benefits is guaranteed 25% of the member's gross and can receive up to 66 and two-thirds of the member's pension. So basically, what this is saying is, if there's a large value that surviving spouse gains off your Social Security benefit, we can take that down to over to 25% basically of the overall pension that you would have got. But that would be a much larger Social Security benefit than you. And if it is like that, you might do the Social Security offset with a reduction of the 3.825%. Again, best thing to do is have your Social Security benefit and your spouse's Social Security benefit. It makes more sense when it's your numbers. Rule of thumb: if the survivor is gaining dollars from the Social Security as a result of the spouse's death, the 50% offset applies to the gain. An eligible survivor annuity is paid to the surviving spouse for the rest of their lives too. So they will get a pension benefit the rest of their lives if the member passes away. Reversionary. Reversionary is giving dollars on top of the by law part. So in other words, you can make this one-time election to reduce your pension to have provided a lifetime income for a designated dependents. So that's one person. You can't change this designation after you retire or at the time of retirement. You're doing all this. Most members do it for their spouses. Some I've seen do it rarely for the dependent children if they're eligible as a dependent at the time the member retires, of course. Um, you can do it in 10% increments, up to 100% of the pension. No COLA increases, so the reversionary amount never gets a raise. It's a locked-in dollar amount to that person only, and that money never changes over the years. And again, this only takes place though after the member passes, that this money starts being designated to this person. But remember, it's irrevocable. This reduction is for the life, even if the designated person dies or if there's a divorce. So you will never get your money back on this. I guess I should have said this earlier. That Social Security offset we talked about earlier, if you did that for your spouse, you would be able to get that original dollar amount get added back into your pension if that spouse did precede you in death, for that reduction. But with reversionary, there is no going back. It's locked into that person only. So if they were to pass away before you did, there's nobody going to get that money you locked in for them, and you don't get the dollar amount back that you had reduced off your pension for it. So this is a good example. Person's pension's $4,000, 100% reversionary, meaning they're going to take $433 for this 100% reversionary out of that 4,000. So now the pension's $3,567. The 100% reversionary means the spouse or the survivor you designated this reversionary amount to is now $3,567 also. So that's what they're going to get locked into their name. So if you passed away, that surviving spouse receives the 3567 reversionary amount plus the 66 and two-thirds by law. So that's 2378 because that's 66 and two-thirds percent of the pension that you're starting at 6567. And then the benefit total payout, they're going to get 54.95 a month. So they actually got more money if you're doing the 100% reversionary than what you did as the member retiring. Survivor benefit, like this 2378, will get raises, but the reversionary amount never changes. Now let's say they did 50%, it costs a little less. The pension's $4,000. Take away the $230 for the 50% reversionary. Now the pension's $37.70. That's your pension as the member. You're taking this dollars amounts away from the starting pension. Now this is your new pension you get every month by doing this 50% reversionary. And so half of 37.70, which is 50% reversionary, is 1885 is the reversionary amount. Now, if you pass away, the 3770 is subject for that 66 and 2/3%. So 1885 plus 2513, that surviving spouse gets basically, or the survivor gets 43.98 a month. Again, the survivor benefit gets increases, so like the 2513 would get an increase, reversionary amount will never change. You can do all these elections. You can do Social Security offset. You can do level income. You can do reversionary or any combination of the above. COLA increases will when you're eligible with or without offset. So, like reversionary never gets a raise, but Social Security offset, you will start getting raises on your pensions if you chose that 3.825% reduction. It'd take a few raises, but that would add money back into your pension that you had reduced. Level income, that again, most tier twos don't do that. If you did level income, that's really taking more money away from your pension in the long run than we gave you. Um, Disability, there's three different types of disabilities. Non-ox means you're hurt outside of work. Occupational means you're hurt on the job. Temporary means you're fighting with workers' compensation or your agents because you said you were hurt on the job, but they're not giving you workers' comp yet. So requirements for non-oc disability benefits are at least 18 months of credit, of service credit, which could be with SERS or reciprocal service with TRS or SURS. You do have to use for non-oc requirements all your accumulated sick time. You must be granted a medical leave of absence by the agency. You must apply by submitting all required forms to SERS. SERS determines if you're disabled. Disability must continue beyond 30 days after stopping work. So not only do you have to use all your accumulated sick time, but hopefully you have enough to cover 30 days before you could even start this non-oc disability. Requirements for occupational, you must be a member of SERS. You must file a claim with workers' compensation and receive benefits or a settlement. File the required forms with SERS. Members do not have to use any benefit time though to receive occupational disability. So again, the theme is though, file your disability paperwork with SERS. Requirements for temporary disability, and you must be denied by workers' comp. You're filing an appeal with the Illinois Workers' Comp Commission. Applications for adjustments of the claim. SERS finds you are disabled from performing your assigned job duties. You've not received nor had a right to receive any compensation for at least 30 days from work, though. And you still must have 18 months of service credit for this, too, to be eligible for this. Disability webinar. SERS is pleased to announce a webinar dedicated exclusively to SERS disability benefits. This disability webinar helps understand the disability benefits that SERS offers to its members. This workshop will help members understand the eligibility requirements for each type of SERS disability benefit. Members can view the SERS disability webinar on our website, which is our general website, under the SERS/workshop and webinar section. Same place you'd find this seminar. Insurance. Not too much goes through SERS for insurance. We're basically reporting your years of service to My Benefits. When you're retiring, insurance goes through My Benefits. Today's information is based on current policy and is always subject to change. Insurance changes are because of contract negotiations or policy rule changes at CMS or even legislation. Read all the information in your pension packet. There is a retiring insurance checklist. There's a couple of group insurance. There's a group insurance fact sheet. There's a Medicare fact sheet. So definitely look over all those fact sheets in your pension packet. And it gives you contact information for My Benefits, or even if you're on Medicare, for the Medicare unit in CMS. So again, you got to be vested for 10 years of service to be eligible for the health insurance, which also qualifies you for the pension. And you can visit My Benefits Service Center will assist with state members with insurance. It's at mybenefits.illinois.gov, or you can call the My Benefits phone number, the 844-251-1777. Change to insurance can be made during retirement. You actually have retirement gives you a 60-day window. A qualifying event could be something after retirement, such as you moved. You get a 30-day window when you submit your change of address to CSRS after you retired and you move. You get a 30-day window to change health insurance plans, which you might need to depending on when you're moving to. And then benefit choices period for someone non-Medicare is May still, which takes effect July 1st. Once you're on Medicare A and B and on the Trail program, your benefit choice period will be October, November, and that will take effect January 1st. Retirement dates coincide with insurance eligibility. Um, I will not. I will make sure. I would recommend you talk to your agency about this information now, because there used to be some agencies make you work the last day, some don't. So I recommend you talk to your agency because this is the all what happens before your retirement date. We just are taking care of things the first and after, and that, you're retired, so you're not going to work. Anything prior to that, whether it be taking off work, with using benefit time, or what day you can resign, which is usually I just say the end of the month. If you're going to try to resign sooner, talk to the agency and see how that works first. State group insurance premiums for the state it will be automatically deducted out of your pension check. If for some reason though your pension check wouldn't cover those insurance deductions, CMS will bill you and every month, and you'll pay them directly. So you get a pension check from us, and they'd bill you directly. But if your pension check's good, a large enough amount, you'll just have all these deductions taken directly out of there before we pay you the pension check. Opt-out financial incentives for CSRS retirees. You got to be under Medicare age, but if you're non-Medicare and this money doesn't come from CSRS, it comes from CMS, but you have the option to opt out of the health insurance. So say you're 62 when you're retiring, or 60, you have other health insurance options, and if you had 20 years, CMS will give you $500 a month. If you had less than 20 years, CMS will give you $150 a month. We don't see a lot of members opt out of the health insurance, but every once in a while there'll be a few that like have a TRICARE or something like that. You're still eligible for life insurance, but when you opt out, you're not eligible for health, dental, or vision or prescription coverage. And if you opt out as a member, you cannot have a spouse on there. So the spouse wouldn't be eligible to be on the health insurance if you opted out too. Um, the biggest thing is though this incentive, this money only is if you're under 65 that you get this from CMS. You can opt in during benefit choice period or at the loss of the other health insurance coverage, because to opt out you had to prove you had health insurance somewhere else before we let you opt out. Um, so to opt back in, you go. This is all done through CSRS. This is one part of the health insurance. If you're opting in or out, you do it through CSRS. Reciprocal time, we kind of talked about it a little bit earlier. There's 13 systems. When it comes to health insurance, though, TRS time, that will count with your years of service with your SCRS time or CSRS time to help reduce that cost. Maybe between TRS and CSRS, you have 20 years, you get free health insurance. GARS, JARS, those all time help. SURS depends on where you worked, because sometimes SURS you paid in, like if you worked at SIU School of Medicine or one of the major universities, you paid into a state insurance plan just like you're on right now working for the state of Illinois or under CSRS. But you could have worked for an out like a junior college or something like that, and you may not have the same health insurance then. So SURS time, or State University Retirement System time, we got to look at to see if it counts with your CSRS time, State Employees Retirement time for health insurance cost. IMRF, a lot of members have IMRF. That's not the same type of health insurance plans whatsoever. So IMRF time, reciprocal time, does not count with your SERS or State Employees Retirement time for health insurance cost. Members' health insurance premiums will be based upon the following: 20 or more years service against free. Less than 20, you pay 5% per every year under the 20 years for the health insurance cost. There's rate sheets out on our general website for that. Please refer to these websites to view current rates and schedule of benefits for each plan. There's our general website, and then there's the mybenefits.illinois.gov general website, and of course CMS benefits. If you Google CMS benefits, it has a lot of information on there too. Dependents, you can continue to add or terminate dependents at retirement. Rates are the same for dependents of retirees as they are for employees. So in the benefit choice booklet, if you want to know how much your dependent costs you for health insurance each month, The benefit choice booklet has the cost on like page 3 at the bottom. You're looking at one dependent or two plus dependents and find your health insurance plan. That's where the cost comes out of the pension check, comes right out of that booklet. Your dental cost comes right out of that booklet. And then you can look at your My Benefits page too for your life insurance costs. So there's 3 of the 4 deductions right there out of the pension check. So you'll have federal taxes, life insurance, or excuse me, federal taxes, dependent health care if there is a dependent, dental, and life insurance costs come out of the pension check. If a dependent is Medicare Prime, health insurance rates will be reduced if the member is retired. So if you're over 65 or one of you or your spouse are over 65, that's going to change things and cost less then. Now, this annuity waiver, this only applies to if both of you were state employees and say one of you retired um, and the other just resigned the job because they weren't eligible to retire at that time. They're going to come back later and get their pension. If that spouse was on your health insurance for over a year prior to them becoming an annuitant or collecting their own pension, they can stay on your health insurance as a dependent cost. Where if they had, 10 years on their own and they went to go get their pension, that cost of health insurance would be much more expensive than it would have been staying on your costs as a dependent. Now, this only works if that one spouse is not collecting their pension for over a year. If you're both going to straight into retirement, then you both have to have your own health insurance plan. So this is kind of rare, but it's every once in a while it works for someone that both of you work for the state. One of you retired, one of you just resigned at that time and came back over a year later to collect their pension, and then that person was able to stay on the other member's health insurance as a dependent because they waited over a year to collect their pension. Survivor insurance basic information. Survivor eligibility. Deceased members must have been vested in SRS for at least 10 years. Survivor must be eligible to receive a monthly pension. So you must have been married at least 1 year prior to that member's death, and they must be at least age 50 or over, unless there's dependent child or children involved. Then that age 50 doesn't apply. But if they're on their own and there's no dependent children, it's got to be 50 before they can collect a survivor pension from CSRS for the member passing. Medicare is a federal health insurance program for individuals 65 and older, individuals under age 65 with certain disabilities, and individuals at any age with end-stage renal disease. See Medicare fact sheet for more information. Again, Medicare fact sheets also got the Medicare CMS Medicare units number on there to call to get more information too. Please note, CMS will mail a letter to the member 90 days prior to turning 65 that provides important information on both the requirements to enroll in Medicare and the transition to Trail Medicare Advantage prescription drug program. This is if you're retired. They do not mail you this letter if you're actively working. It's only after retirement. If you and your dependents receive or have Medicare cards from SSA, please send a copy of those cards to the CMS Medicare Coordination of Benefits Unit to ensure your insurance is coded correctly to avoid claim and or premium errors. So if you are Medicare age at retirement, not only will you turn in your packet for retirement, say for January 1st, or for example, if you're going to be over 65 when you retire, you need to be on Medicare Part A and B for that date of retirement too. Very important. That's why it's important to read those fact sheets in that packet. And that's also something we go over at the appointment with you to let you know, hey, contact Social Security. You got to not only do stuff with your agency and stuff with CSRS, you now need to contact Social Security Administration because you're over 65. For more Medicare information, this is who you contact, the Medicare Central Management Service Medicare Coordination Benefits Unit. There's their address, there's their phone number, and they got a fax, and of course they have an email there too if you need to email. But that's who you talk to about the Medicare and how your insurance changes to this Trail program if you're over 65 when you retire. Life insurance is administered by MetLife. There's their phone number. So if you need to do beneficiary form, there's who you call to get your beneficiary form for MetLife. You can also go to metlife.com or /state of Illinois /. And then state life insurance examples. This is just the person makes $50,000 a year. So They're based on 50,000 a year salary. They have times four, it's another 200,000 for a total of 250. They have a child on there, which is for 10,000, and they have a spouse because that spouse is under 60. That's 10,000. So you could have quite a bit large life insurance policy just while you're working or even under age 60. So if you retired under the age of 60, you'd actually have been able to keep the health or the life insurance value the way you have it at the agency. But tier twos, we're looking at 60 or older, so everybody's looking at this for life insurance when you retire. Since you're looking at 60 or over as a tier two, your basic life goes to $5,000. It's no longer based on the annual salary. It's 5,000. The most you can have is another times four, and that's if you had the times four in place before. That's 20,000. So you have a total of $25,000 is what you can have through the state in retirement at 60 or older. So your life insurance value significantly changes. If you wanted something different, you might have to look outside. MetLife is its own private and life insurance provider, so you can always contact them, see what they can do too. Um, you still, though, if you have a child, I think they got to be under like 24, 25. There'd be 10,000 on them. And then your spouse, though, your spouse's age based is theirs. So if they're under 60, they get 10,000. If they're over 60, it's 5,000 is all you could have. Voluntary, this in CPERS. This is a good deal if you think you need extra life insurance. In CPERS is the National Conference on Public Employee Retirement Systems. It's not, there's information on our website, but this life insurance doesn't come from CSRS. It comes from this organization. It's through Prudential. You can sign up for this while you're actively working. Because it says retirees are not eligible to apply, but while you're actively working, you can sign up for this. It's a decrease in term life insurance policy. Again, we have some information on our general website about this under the insurance tab, and you'll see in CPERS there. Um, it's offered through Prudential. It is only $16 a month, and as long as you started this as an active working member, you can actually keep this in place in retirement. So this kind of could help make up for how much the life insurance falls once you retire because you're over 60. I think the basic payout's still around $7,500 to somebody later on for that, and you're paying $16 a month. And that $16 not only covers you that a month, that covers it gives you so much for your spouse too, along with your policy. So again, as long as you had this payroll deducted before retirement, you'd be able to keep this in CPERS. There's information on our general website. It's not goes through us. You got to contact them directly. It is through Prudential. That's the underwriter, and it's enrollment for active employees. This is very important information here. This is our contact information, deferred comps, Social Security Administration's contact, My Benefits, and Empower. And Empower is the investor that deferred comp uses. So that's currently who you would contact if you retired 30 days after you retire or resigned your job. Basically, you can contact Empower directly if you want to do something with your retirement money there. Well, thank you for listening to my seminar. I hope you enjoyed it. If you do have questions, again, our contact information is right here on the screen. srs.illinois.gov is our general website to look up stuff. There's our general CSRS email, and there's our call center number. Thank you, and have a good day.